Our next speaker is Keith Bowers, who is the Chief Executive Officer, Managing Director of Lotus Energy. So Lotus will be familiar to all of our listeners, been a regular participant in our conferences, in the process of bringing the Kayelekera uranium project back into production. This is a brownfields restart project based in Malawi. And Keith, you've been doing a lot of work in the last couple of years on improving the operations at Kayelekera in terms of what it will look like when it comes back into production. For those who have followed the story, Kayelekera did operate under it was owned by Paladin Energy previously, and operated successfully, but at a reasonably high cost compared to where I think Keith, you're going to be able to get it to now. And you've got some good catalysts coming up in the short term, which should see us back into production hopefully by the end of 2025, early 2026. So Keith, over to you. Share your screen and look forward to hearing the update.
Thanks very much, Andrew. If you just confirm you can actually see my screen.
I can see your screen.
Perfect. Thank you very much. So, thank you very much for taking the time to listen to me and my story about Lotus Resources. I always like to start off with this slide in my presentation. I think it really just shows to the audience and to the investors exactly what we have on site at Kayelekera. So that there is a picture that was taken a few years ago of our Kayelekera site and clearly demonstrates all the existing infrastructure there. So we have an existing plant, we have the tailings dam, we have access, we have camps, we have everything like that on site. And because of that, Lotus, or at least Kayelekera, is a relatively quick restart with a small amount of capital that is required to be able to bring this plant back into full production. Just a little bit about the corporate stuff before I move on to the project area. So today our share price trading around 41 cents today, giving us a market capitalization of almost 770 million Australian dollars. So for our international listeners, that's around about $500 million US dollar market cap at the moment. We have $40 million in the bank, so that's a combination of the cash position as of the end of December quarter, but also includes the $30 million that we raised a few weeks ago. We have zero debt at this point in time, about 1.8 billion shares on issue as well at the moment. Just also like to raise a little graph there on the left-hand side there, just showing the current distribution of our shareholders. Still a very, very significant amount of Australian retail, also some international retail there as well, specifically North American and some European as well. Although we have started to see a growth in terms of not only our institutional shareholders, but also through the ETF funding as well. And very, very happy to be able to say that a few days ago, or on the 18th of March, Lotus got promoted into the ASX 300 as well. So we have seen a significant buy-in as a part of that rebalance of that process as well. Just so what is Lotus as a company about? Well, we're obviously very much uranium focused. We have the two projects. I've already spoken about the Kayelekera project, but we do have a second project, and this was the Letlhakane project that we acquired through the merger we did with ACAP Energy in last year. That was completed in November of last year. These two assets, the production-ready Kayelekera asset with the much larger scale growth asset that we have in Letlhakane, means that Lotus is a company that has a resource of around 241 million pounds. That 241 million pounds of uranium resource makes us the third largest uranium resource on the ASX at the moment. As I mentioned, Kayelekera, proven production history there with the operating plant. According to the existing studies or the DFS that we have at the moment, 10-year life of mine associated with this. But where we see the real growth for the company coming through is through the second project that we have, the Letlhakane project that we have. And I'll show you in a couple of slides' time just how we see these two projects working together to effectively give Lotus the opportunity to be a company that can be producing uranium for the next 20 to 25 years. As everyone who's familiar with uranium at the moment knows, we're in a very, very strong market at the moment, probably the strongest market in the last 14 or 15 years. The price has drifted down from the high $107 that we saw towards the beginning of this year, but still in a very, very strong position at the moment. A proven management team, we've got lots of experience in Africa, lots of operating experience, lots of development experience, and also uranium experience. However, we do recognize we are at a point in our growth now where we need to start building our team up as well. And we've already started that process. We're looking at appointing a project director for the Kalakeara project to take us through our feed, through our detailed design, through the execution of the project. And we're also bringing on an experienced study manager as well to help us with the Letlhakane project. And we're also starting to identify the roles that we're going to need to bring on site at Kalakeara in order to be able to deliver the restart of that project in the timeline that we're talking about. A quick touch just on some of the long-term drivers affecting the uranium market. I think these are pretty well known to the audience, but I mean, really three main areas we're seeing at the moment. Specifically, the US, lots and lots of policies coming out there at the moment. I think one of the key things that people are waiting for is to see whether this ban on the importation of uranium from Russia is going to pass through the Senate. If that does pass through the Senate, I think we're going to see a significant jump in terms of the spot price, with hopefully an increase in the equities coming on the back of that. China is such a huge success story for the uranium industry. I mean, they're talking about approving up to 10 new reactors every single year between now and 2035. They're talking about building 150 reactors within that time. It looks like by around 2030 or so, China will take over the US as being the largest uranium consumer in the world. And of course, we know in Europe, there's also good stories coming out of Europe as well. Lots of life extensions there to reactors, new reactors being considered in Scandinavia, in France, in the UK, and in Eastern Europe as well. So really, really good news from a global story coming out. The interesting thing, I suppose, for us as a producer, well, what does all of that mean from a demand perspective? And I think that the data that was put out by the WNA in September of last year is very, very good in terms of providing some indication of what this looks like. So the graph there on the top right-hand side there, that indicates how much electricity is going to be or has been generated in 2022 and how much they are forecasting will be generated from nuclear reactors up until 2040. So you can see, even if we consider the period of 2022, where there was around 366 gigawatts of electricity generated from nuclear reactors, well, the question is how much uranium is required for that. Those reactors require about 169 million pounds of uranium. Yet primary producers, so we're talking about mining here, only produce 30 million pounds of uranium. That means approximately 39 million pounds had to come from secondary sources. Secondary sources are normally inventories, but also what they call underfeeding in the enrichment process. Both of those are at risk at the moment. We know the inventory levels are on the way down, and we know with Russia's invasion of Ukraine that the opportunity to be able to continue underfeeding, at least in the Western enrichment facilities, is dramatically reduced as well. The market or the industry will no longer be able to rely on those two forms of secondary supply to be able to support what's going on. And if you forecast forward through to 2040, WNA's forecast is that by 2040, nuclear reactors will be producing something in the order of 686 gigawatts of electricity. That means these reactors will need something like 335 million pounds of uranium. Yet producing mines today, or those mines that will still be producing in 2040, only produce about 65 million pounds of uranium by then. There is room for a huge number of new projects, or there is a need for a huge number of new projects to come online within the next decade or so to be able to deliver the uranium that's required to be able to feed these reactors. And I think that's the main story behind the uranium industry at the moment. Just talk a little bit about some of our projects then. So Kalakeara, as I mentioned, I showed you in that picture on the first slide there, past producing asset, has an existing plant that's in good condition at the moment. It is a proven producer. It produced 11 million pounds when it was operating between 2009 and 2014. It has its mining license. It has an environmental license in place. Therefore, from a regulatory perspective, there is no issues to restarting this mine back up again. We also know we have access to some of the previous employees that worked at Kalakeara. We know when we acquired the asset and we're talking about restarts, there were lots and lots of the previous employees approached us and were asking about when they can get their jobs back. So we will be able to start up with a good base when we restart this mine up with regard to having skilled or at least semi-skilled workforce coming online. The DFS for this project, so on the back of all the work that we did post the acquisition of this asset in 2020, we did a lot of work around optimizing the project, around optimizing how we were going to operate this mine. The DFS we put out in August 2022 really wrapped up all the results of that and showed that we have a low capital restart, around $88 million of upfront capital, a 10-year life of mine producing about 20 million pounds during that period, but quite heavily biased towards the front end of the schedule, 2.4, 2.5 million pounds per annum for the first 7 years. Production drops off in the back end as we start to treat the stockpiles that were produced during the mining period. We've also been able to demonstrate through the work that we've done, we've been able to reduce that cash cost. So cash costs are down to around $29 per pound, all-in sustaining costs around $36 per pound. And also on the back of the DFS, we will also be able to define what the timeline was for the restart. So we're talking about 15 months to be able to restart this mine. Now, based on our view on what's happening on the market, we've given ourselves a target that we would like to see Kalakeara up and running by the end of 2025. That's our target. We think that by having the mine up and running by the end of 2025, we'll be able to take advantage of the high price environment that we expect to see will be there between 2026 and probably as late as 2028 or 2029. According to that timeline, we need to make final investment decision by the middle of this year, and that's what we're targeting at the moment. I just want to talk a little bit about some of the stuff we've done at Kalakeara as well. I quite often get asked the question, how have you guys been able to reduce your operating costs from where they were when the mine operated back in 2014? And there's a couple of things that we've done there, but I've just highlighted the 4 main areas that we've been able to touch on since we acquired the asset. So we've been able to increase the ore reserve. We've increased it from 14 million pounds to 23 million pounds, which has given us the life extension that we're talking about, the 10-year life of mine. At the same time, we've obviously also been able to increase the mineral resources associated with the Kalakeara project. But more importantly, what we've done from the cost perspective is that by working on things like power, so how we connect the plant to the grid rather than using diesel gensets, how we've been able to work on acid recovery, how we've been able to work on beneficiating the ore prior to feeding it into the mill. These are all the things that we've been able to do to be able to drive those costs down. And we've brought the cost down from around $36 per pound down to around $29 per pound. As I mentioned, a key component of that is what we've done with the feed grade. So we've been able to increase the average feed grade that comes out of the mine onto the ROM pad from around 600 ppm through beneficiation and specifically ore sorting up to around 800 ppm. And that's also had a significant impact in terms of our production profile, but also our cost profile for this project moving forward. Just to give people a little bit of a sense in terms of the economics of this project as well. So some really, really simple way of doing this. If we assume that we were able to achieve a spot price of around $93 per pound or a price around $93 per pound. As I mentioned, our cash costs around $30 per pound, another $8 there for all-in sustaining costs, giving us a potential margin there of around $55 per pound. At 2.4 million pounds per annum, that means we have an EBITDA of around $132 million per annum. When you take into account our upfront capital requirements of only $88 million, that means this project has a payback of less than 1 year. So what are we working on in terms of being able to make sure that we're going to be able to get Kalakeara up and running by the end of 2025? As I said, we're targeting a final investment decision by the middle of this year. We've appointed an experienced project director to help us through this process. We're busy with our front-end engineering and design. We're talking about power, as I mentioned. We're looking at connecting the plant to the national grid rather than running off diesel gensets. That has a significant impact in terms of reducing our costs. We're busy negotiating with the Malawian utility about that connection. We're also in the process of sorting out our financing. We're about to appoint a debt advisor to help us look at the debt opportunities out there in combination with equity, but also some prepayments that we're hoping we'll be able to get from the utilities, and that seems to be a real opportunity for us based on the conversations we've had so far. Offtake, we've had lots and lots of interest from various North American and European utilities, and we're in negotiation with a couple of those utilities about a potential agreement. And the other thing we're busy with at the moment that we have been speaking about for a while now is the mine development agreement with the government of Malawi. So this is not required to be able to start the mine, but it's something that is a really good to have when we start the mine up, because it sets the fiscal regime in which the project will operate and also ensures that we have a stability period in which the project will be protected from any changes within the Malawian law. We've been making some good progress on that. I'm hoping in the next month or two to be able to make an announcement to the market around that. So just quickly talking about Letlhakane. So Letlhakane, as I mentioned at the beginning of the presentation, is our long-term growth strategy there. How do we see this project working together with Kalakeara? Well, we see Letlhakane coming in about halfway through Kalakera's production profile. And that's demonstrated or shown in that graph there at the bottom right-hand side there. The blue bars representing the production rate from Kalakera's feasibility study, the green box representing the potential that Letlhakane has. So Letlhakane, we still have got some technical work we need to be able to do around that project so we can set it up to be a successful operation. We think that's going to take us about 3 years or so, followed by final investment decision, and then probably about 2 years or so to build that project. However, Kalakera will be up and running during that period, and the intention is that some of the profits that are generated from Kalakera will be used for the development of the Letlhakane project. As I mentioned at the beginning of the presentation, we're putting these two projects together. Lotus is going to be a company that will be producing uranium, something in the order of 2.5 to maybe as high as 4.5 million pounds of uranium for the next 20 to 25 years. And that's a story that the utilities love. They love the idea of being able to build a long-term relationship with the producer going forward. Just a little bit about the Letlhakane program in terms of what we're trying to do. So as I mentioned, we do have some technical work. We've got a lot of stuff we're planning on doing this year and running into next year, including updating the mineral resource estimate, focusing on the higher grade zones. We have an infill drill program planned. We've got some geometallurgical modeling that we're doing to try and support our program going forward. We'll be doing a preliminary mining study, which will then flow into a scoping study. At the same time, we've also got some metallurgical test work that's ongoing at the moment. Again, we're looking at this beneficiation process. We believe a lot of work we did at Kalakera is directly transferable to Letlhakane from a beneficiation process, and will we be able to do that same thing with that ore to be able to increase the grade? Once we've identified whether we're able to increase the grade, we'll be looking at a flow sheet. Do we still follow the existing or the proposed plan that ACAP put together, which was around a heap leach project, or do we actually look at trying to duplicate the Kalakera circuit at Letlhakane? For me, that would be first prize. If we can duplicate that circuit at Letlhakane, all the lessons learned, all the synergies, everything like that, we'll be able to transfer across to Letlhakane and be able to do that. So, Andrew, that's the presentation. I'm happy to take any questions if you've got any.
Yeah, thank you, Keith. We do have time for a couple of questions. And yeah, I guess the first one from me, Keith, is, and you and I have had this conversation before about the market opportunity here is clearly opening up. There's a window of high prices for uranium, 26, 27, 28. So, a sense of urgency of getting Kalakera back into production to take advantage of that window. And you've obviously got some trade-offs here between not wanting to rush things too much, but also wanting to get into that window. With the mine development agreement in particular, then what's the process now to get that completed and finalised? And then once that's done, how quickly can you then get Kalakera back into production?
So from a MDA perspective, the documentation or the agreement document, the draft of it, is actually sitting with the government at the moment for their review. We are in the process of arranging a meeting with them for them to provide us with some feedback on that document. It is our understanding that the way that we've drafted the document is based on the lengthy negotiations that we've had over the last year or two. So we're not expecting a huge amount of pushback from the government on any of the terms that we've got in that document, as they've at least verbally been agreed to in the various meetings we've had. We do talk a lot about the fiscal elements within the document, talking about royalties and tax rates and duties and tariffs and that. But there is another component to that document where we're talking about, arbitration and dispute resolution and all those types of things, which we have also included that are standard in these types of documents. And I think it's just taking the government through those parts of the document is going to take a little bit of time before we get both sides comfortable with that. But as I said in the presentation, I'm hoping within the next month or two to be able to make an announcement to the market on that MDA document. You talk about the urgency of timing as well, and I think that was really behind that capital raise that we did a few weeks ago. We recognize the opportunity there to bring in some long funds that have the same belief as us with regard to the uranium market. By bringing in that $30 million has also given us a bit of a breathing space and also an opportunity to accelerate the restart. As I mentioned in the presentation, end of 2025 is our target for the restart of this mine. by bringing in that $30 million, we're actually in a position now where if we need to, we can place the orders for long lead items. We now have the cash in the bank to be able to place those orders. We can also undertake some of the early works programs that we've identified on site. And then an example of that would be maybe the refurbishment of the camp. There's nothing stopping us starting the refurbishment of the camp now to have that in place. So when we start to bring the construction crews on, they're not staying in tents or whatever, they're actually staying in the camp that we've already got there. So those are the sort of things that we're looking at using that money for. And we certainly believe that we have de-risked the timeline to the restart of Kalakeara by bringing in that money to allow us to do the acquisition of the long lead items and the early works programs that I've just described.
Yeah, great. And so it's about a 12 to 18 month restart process from when you hit the final decision, let's go, about that time frame?
Yeah, we said 15 months in the feasibility study, 15 to 18 months. So if we make final investment decision by the middle of this year, we should see Kalakeara up and running by the end of 2025.
2025, yeah, very good. And what's your expectation in terms of timing for announcements for any offtake agreements?
As I mentioned, we are in quite detailed discussions with one or two off-takers at the moment. Obviously, with Malawi being not the not in Namibia or something like that, one of the things that the utilities are looking at is actually doing a little bit of due diligence on Malawi itself. So I do know, for example, that a number of the utilities have had some detailed discussions with the US Embassy in Malawi to get some background on Malawi, to get an idea of the sovereign risk associated with it. I'm glad to say that those conversations have gone very, very well with the US Embassy there. They've always been very, very supportive of us in terms of getting this mine up and running. So we're just going through that process, that due diligence process with a couple of the utilities.
Yeah, terrific. Well, Keith, look, thank you so much for making time for us today. That's been a terrific overview, and best wishes in the next little period with the mine development agreement, offtakes, FID very soon, and then hopefully we see Kalakeara back into production before the end of next calendar year, which would be perfect timing for what we know is going to be a very, very robust uranium market. So good luck with all that.
Thank you very much, Andrew.